Welcome to the Options Income Blueprint Weekly Income Report. This is Michael Schulman on December 12th, 2022. We have live trading tomorrow, 11 o'clock Eastern. For those of you in Income Madness, we have live trading today and tomorrow at 12 o'clock Eastern. I'm going to go over the trades and results from last week, spend a little time explaining why I took a significant loss on Sunrun. And then I want to talk about short-term trading through the prism of looking at our trade desk trade and the Williams-Sonoma trade, both which were nicely successful. So last week, closed trades. The Williams-Sonoma had closed the week before, and you could see the big hit, and it's not minor. It was a 31% loss. I mean, the stock was down considerably more than that, based on where we started. But because we've been generating cash through either the sale of puts or calls, our loss was a little less, but that's not making any excuses. It's a big hit, and I'm going to go over why I decided it was time to move on. We did put out new positions, generated cash, very nice rates of return. Marvel, of course, was after, and then before and after earnings announcements. The trade desk was an open and close for a week. And as you can see, our goal is 26% a year. We did 31. We have the occasional off week, but I'd say 4 weeks out of 5, we're hitting those numbers. We're doing our 26% or more, and sometimes we're doing double that. Now, overall performance, you then include roll trades. That previous discussion was on new trades. The roll trades, and I've substituted, you could call it a core position, Bank of America for Citigroup. The bottom line is they're generating huge amounts of cash every week or every other week, and they're very, very large rates of return. They're very, very important companies in their sector, and even if you've been in them a long time and your tracking spreadsheet says you're down, these are the ones we're using as cash generators that are over time going to outperform the market. So last week, the market began to respond. It's always keeping an eye on, but the market was truly responding to the Fed announcement this week. And I guess the question is, when I look at the bounces up and down in the market, does anybody think that the Fed's not going to raise the 0.5%? The issue will be neutral to dovish or neutral to hawkish language. But the hints were being dropped all around. That's been going on for weeks. The other thing that happened last week, and there was a positive market response to it, was wholesale inflation data. It's still hot by the standards of the last 15 years, but it was significantly lower than expectations. The other thing, and the market did not move, was China easing COVID-19 restrictions. In this update last week, I spoke about a term I'd stolen from a political analyst who said China was going to shift from COVID lockdowns to COVID in name only. Well, sure enough, the next day, it's COVID name only, and now there's a big push for vaccinations, and they're lightening things up because of protests and hurts in the economy. And the reaction is not just people being, I mean, you have 400 million people or more under lockdown. There are going to be problems. But the Chinese authorities, who are most concerned, of course, with maintaining 100% political supremacy, they're not stupid. And they were listening, and this is their response. So the Sunrun closeout, there are two reasons I'll close a position. The company is getting hurt and going in the wrong direction in the real world, or the stock is stuck or going in the wrong direction for a period of multiple quarters in the stock market world. And that's what's going on. There are two overhangs in the real world on the company, which is new home building is soft, and a lot of installations in new home building. They have a terrific business model. They get money every month as if there were utility from people who are using Sunrun and had it installed, and it increases their cash flow every time they put on a new installation. That said, there's a concern because of the housing slowdown in new homes, and the other is, will they be able to quickly shift their supply chains, because the Biden administration legislation on climate change, which is gigantic and has large subsidies for solar, it's for Made in America solar. So, but the stock couldn't punch 30, and that's the real reason. Meaning, Sunrun in the long run, the next 5 years, it's a great company in stock if you're going to do a pure play on residential solar. But the bottom line here was the stock couldn't hold 30. It was beginning to trade down. It might not punch 30 again for a year. It was time to move. and the weeklies are illiquid. It was a stock we put on a couple of years ago as a core position, but it was so illiquid, and at the time it was monthlies only. I warned people about that, but it causes problems. If you stay in the stock, please send me an email. I'll give you some guidance on where I think the company is going or where the stock is going. I want to talk about very short-term trading. This is a tactic, of course, I've always used in Income Madness, but started to do very short-term trading and being religious about closing to profit goals and rate of return goals. Sort of the second half this year, maybe even starting in the second quarter because of market conditions, where I think we're in a bear. I don't really care that we're in a bear. It's the unpredictability of the market, and that I don't want to get stuck in positions that I think 3 years ago I could have rolled and closed in a week, that I may have to roll and close in 6 months. Don't want to tie up capital that way. And by focusing on cash and rates of return, which is my mantra, it's in the training materials. I have to live by my own. The expression when you go to National Sales School at AT&T, which was really a Xerox training school a million years ago for me, you have to eat your own dog food. And so focusing on your cash rates of return, your annualized rates of return and your cash is really important. So let's go through two trades. The first is the trade desk, and the second is Williams-Sonoma. You take a look at the numbers. You may go, wait a minute, I'm new here, $17 a contract, who cares? Well, if you sold 10 of them, you care. It's $170. 0.4% in 3 days. Remember, the target is 0.5% in 5 days. So what does that mean? It means you have a 49% annualized rate of return. We're targeting 26 minimum. New trades are typically 32 or more. Williams-Sonoma was even better. We pulled in a lot of cash. I felt this was a good example because we gave back a lot of cash to be able to close it. 0.7% in 3 days, or an extreme annualized return of 81%. So let's say you put the two together and you used just one, you sold just one contract, $14,200, 87 in profit. Big deal, right? It is a big deal. And here's the reason it's a big deal. Let's say you don't use Wall Street's metric, which is annualized rates of return, because Wall Street trades on a 7-day-a-week basis. Japanese government bonds, Israeli shekels, corn futures, and stocks. Everything's on an annualized basis. Let's say we did it the way human beings in the service will do it. What am I going to do this week? So let's take a look at a hypothetical 50-week year. You take 2 weeks off. That would be $4,350 in profits and almost a 31% rate of return. Beats any bear market. And the point is, these are the numbers, and that's why we do short-term trading. So specifically, the trade desk, I want you to look at that price. It's $48.14. So we picked up $47 per contract, high potential rate of return of 45%. But 3 days later, roughly the same price, the stock was up 70 cents. But time decay, which is explained in the training materials, time decay is hit, and we're out. And we pick up the $17. Why? Why stay in the position, which would have been open for another 7 or 9 days or whatever it was? And it's a really volatile stock. You may have noticed that when we sold and the stock price was above 48, we sold to 42. I only trade the trade desk with silly puts, 10% out of the money or more. If it's a shorter term trade, 15% or more out of the money if it's a longer term trade. So with that in mind, knowing how exceptionally volatile this is, when you can pick up that rate of return, you go for it, you close the position, you free up your capital, and you move on. Now with Williams-Sonoma, one of my favorite companies in the real world, the stock price is about 114.5. We sold 105, 8% out of the money. And we picked up an enormous amount of cash. And it was a very modest rate of return because it was a monthly, right? It was right above our 32. And it was a monthly, but it was a lot of cash. So the question is, when do you close? Of course, you want to hang on to that cash. But the bottom line was the stock moved. It was up a couple of bucks in 3 days. And time decay had also set in. And you're looking at a position we would have had to stay in for the 2.5 weeks. $70 profit, gigantic rate of return, 81% rate of return. And maybe you trade it again the next week. You've freed up your capital. You've lived to fight another day, quote unquote. It's an old cliche. But when the money is there, you put it in your pocket. You're freeing up capital. You're taking risk off the table. There's always a risk when you're in equity markets and so forth and so on. So going forward, let me recap. For those of you who are new, it's that 0.5% a week minimum, We're looking at market leaders inside a trend. The Trade Desk, for example, is an almost indispensable company for most advertisers trying to figure out, do I want my ad to run on the iPad, the iPhone, 12 o'clock or 11 o'clock, on a streaming channel, through Roku, direct to Amazon Prime? Do I want to advertise on the Amazon website? Do I want to do this with Google Ads? They have an artificial intelligence driven engine that enables advertisers to do this, and a whole bunch of other support materials. So it's a large company. Williams-Sonoma, premier retailer, Bed Bath & Beyond is going. Amazon sells roughly at the same price as the very high-end things that are sold at Williams-Sonoma. They've made a great transition to online in addition to brick and mortar. And during the pandemic, when people started, who hadn't been cooking a lot, where do you go? And you want quality. You want something that's going to last 20 years, you go to Williams-Sonoma. So if you're on your own, of course, send me an email if you have questions. I use the 3, 5, and 30-day charts. The chains have to be liquid, and the premiums have to be large enough to hit those goals. So this week, we're waiting on the Fed. Doesn't mean we're not going to trade. We're going to trade on Tuesday, and we're going to be waiting on more retail data. We're getting a mixed bag that consumers are pulling back, but my mixed bag tells me they're pulling back either from market saturation, which was Lululemon. I bought all the comfy stuff during the pandemic. Slight miss on earnings and growth, so the stock tumbled. We don't trade Lululemon, it's too expensive. But it's an indication that a lot of money has shifted from high-end retail to travel, and so forth and so on. So we're waiting for more retail data, and we're preparing for the new year. We're not going to sit on the sidelines. There's no equity, pardon the pun, in that. And we're going to open and close with this kind of rapidity going forward. I don't see that changing anytime in the first 2 quarters in 2023. And what looks good for 2023? I'm teasing you. Come back next week, week after. We'll start taking a look at 2023. This is Michael Schulman. Thanks for listening.